everyone. Thanks so much for joining the call today. My name is Emma and I'm the Relationship Manager here at Casterbridge, and I'm joined by our Head of Strategy and Managed Portfolios, Julian Menges, and Ed Leggett from the Artemis UK Select Fund. So we've been receiving some really positive feedback from financial advisors about the way that the Casterbridge managed portfolios have been performing over the last 1 to 2 years, particularly last year in 2022, when they were significantly outperforming many of their peers during what was really quite a difficult period. So advisors and their clients were keen to learn where this performance is coming from. And one of the funds in the portfolios was the Artemis UK Select Fund, which Julian has been invested in for a while now. So we thought it would be a good idea for Julian to interview Ed, the lead manager on that fund, on behalf of advisors and their clients. So Julian, over to you.
Lovely, thank you, Emma, and thank you, Ed, for agreeing to do this for us. So Casterbridge have been invested in this fund for several years now. Just to give a little bit of context, we're trying to find funds which take a slightly different approach, and having taking a different perspective on what's happening on the underlying UK economy. Just to give some numbers, just to sort of help set the scene. So far this year, for example, the FTSE 100 has returned around 4%, and the Artemis UK Select Fund, which Ed manages, has returned around 15%. So some quite significant outperformance. There's no big pressure on Ed, that's always going to happen, but that's the sort of the differentiated returns that we can get from managers when they're getting things right. And Ed has certainly been on the right side of things for the last couple of years, which during what has been quite a difficult period. So Ed, I've got a few questions here. Perhaps we could just start by explaining the fund's investment philosophy, please.
Sure, yeah, good morning. Yes, so the fund is a concentrated best ideas fund. So think of it as a 40 to 50 stock portfolio. We're multi-cap, so we're agnostic about the size of company we're investing in. We own everything from Shell at one end of the market down to smaller companies in the small companies end of the market. And what the fund is all about, it's all about compounding long-term returns. Everything we do is looking to compound long-term returns. And that is, the UK is an index that we think has scope to do something significantly different over time. If you're starting with a blank sheet of paper, you probably wouldn't start with the UK index. It's very concentrated, it's very by both company size and by sector. So the top 20 companies in the UK are over 60% of the value of the market. And as a result of that, you can get, some of those companies can, dominate the performance of the index at a given time. So we think it's a relatively easy, compared to some other indices globally, index to outperform. And what we're trying to do is to outperform that index by 3 to 5% per annum on a rolling 3-year basis.
What's almost like the key differentiator for the fund, almost like your USP, as it were?
I think there's probably three. The first would be that 3-year constant time horizon. We try not to get carried away at times of euphoria, and we try not to get all doom and gloom at times of stress. And so keeping that constant time horizon, I think, is very powerful. It's not always easy. You'll know with your own clients, your clients with their own clients. People tend to look at the short-term numbers and not so much at the longer term. The second, would be we fundamentally believe that as long-term holders, the free cash flow that the companies we generate, that we own, generate, will correlate very strongly with our returns. So we are focused very much on free cash flow, and we're looking for companies that can grow their free cash flow through time, and we're looking for companies that are attractively valued on that free cash flow. And the combination of those two, I think, has served us well over both recent years and over the long term. And then the third and final piece, I'd say, is you're speaking to me today. I run the fund with a colleague, Ambrose, but there's actually 10 of us looking at UK equities within Artemis. Across our UK equities funds, we run about 11 billion. And I would think that will put us in the top 5 active managers of UK equities in the world.
I mean, any sort of insights on, your thoughts where inflation interest rates are going to be over the next 6 to 12 months?
I think what we can say, though, on a 6-month view, is inflation is going to be considerably lower. Energy costs, you're filling your car up already, that's a negative on inflation. It's cheaper than it was last year. Your utility bill is falling year on year now in the second half of the year, and it's likely to fall again next year as the global gas markets adjust to Russia not being in the providing pipe gas to Europe. And so, we do think inflation comes down. And I don't think there's any particular reason why the UK should be materially different to other developed economies in the world. The US has had the benefit, it hasn't had the energy price inflation that we've seen because it's sort of self-sufficient, particularly in gas, that we're not. And so inflation, we think, comes down. And when we manage the portfolio, you say, well, we want some things which will do well if interest rates do fall, and inflation expectations do fall. And we also want some things which we think will do well if they remain higher than we expect.
Does that sort of concern you at all about that sort of leading into recession, or do you actually see that's actually quite healthy, clearing out some weaker companies?
So I think investors are sort of obsessed with recessions, but recessions, the most recent ones that have been large have been COVID and the financial crisis. And I think those have been very different recessions from, I guess, other sort of mid-cycle recessions. If we get 2 quarters of modestly negative GDP growth, I think you're going to find lots of companies are absolutely fine going through that. It's not great, it's not ideal maybe, but it's not a disaster.
I think one of the, as I said at the top, we like the way that, you can have a sort of different perspective at looking at things. And one thing which I found particularly helpful over this last year, if I can call it sort of bluntly, it's your assessment of, the impact of savers versus borrowers. So when we had sort of rising interest rates or the energy crisis, again, the media is very much focused on the negative impacts, on those with mortgages. But actually your analysis was looking at very much, the positive impact on savers.
Obviously, interest rates have gone up a lot, and that's, is causing a big repayment or, monthly payment shock for households that are refinancing their mortgages from a very low rate to a much higher rate. But the Bank of England's big problem in slowing inflation with interest rate rises is actually there's relatively few households that have a mortgage anymore. So if you think of the households in the UK, broadly 1/3 of the population, or 1/3 of households rent, of which half is social housing and half is private rented, roughly. The other 2/3 are owner-occupied, of which 55% of those owner-occupied houses don't have a mortgage. They've paid them off totally. They own those houses outright, and 45% do have a mortgage. And of those 45% that do have a mortgage, 80% of those mortgages, more than 80% of those mortgages are fixed. And the majority of those mortgages are fixed for 5 years. So we end up each year with, a very small cohort of the overall household population of refinancing. And then the other thing that has changed, since the financial crisis and certainly since COVID, is that there are now far more savings in the UK than there are borrowings. And there's sort of £1.5 trillion of consumer savings sitting in bank accounts today. And that is significantly bigger than the overall UK mortgage book.
Yeah, no, that's really helpful. And it's that, I say, almost that different way you've been looking at it, or your optimism. It's it's one of the reasons why we've had the fund. I mean, let's leave it there. Ed, I mean, any sort of final thoughts or insights for our audience?
I think probably final sort of big picture, and we quite like this sort of just stand back and take 100,000-foot view of what has and hasn't changed. Would be, if you look at the big change in the last 2 or 3 years for investors, which I think you need to consider in detail, is that the cost of capital has changed. Doesn't matter if interest rates are 2.5%, 3.5%, 4.5%, long-term interest rates, or 5.5%, they're not zero. And that is a very different investment environment from where we've been. If you want to build a new hotel 3 or 4 years ago, you could build a better one that was smarter than the one next door, and you get all their customers to go into your new one. Today, if you want to build a new hotel, it's going to cost you 30 or 40% more because of inflation. It's going to take you 3 or 4 years because of planning and all the building it. And rather than financing at 2%, you'll be financing at 6, 7, 8%. So all those historic assets that lots of the UK companies own today, we think will make better returns going forward than they have done in the past. And you've got an opportunity in the UK today to buy some of these asset balance sheet intensive businesses at very, very low, lowest prices I've seen in my career. Balance sheet risk is generally low, and those free cash flow yields that I talked about at the start we're focused on are in the teens, and in some cases in the 20s. That's unusual, and I think that will give you, over time, strong real returns, regardless of whether inflation is 2, 5, or 7, and interest rates are 2, 5, or 7. We've got that big spread that we're picking up over time, and that I think is a really exciting opportunity. No one cares today because no one's interested in the UK, no one's interested in UK equities, and no one's interested in UK value equities, so some of these legacy industries. But they are performing, those shares. We own quite a few of them in the fund, and that's part of the performance of the fund, and we think they're going to perform going forwards because the cash flow is real, and as a long-term investor, the cash flow is what you get.
Yeah, I mean, it's a very it's a great sort of optimistic point to end on. I think probably what a lot of people sort of think is, almost what's that catalyst for the UK to sort of start outperforming, because it has been a laggard for a long time, and often these things do take time for investors to really, particularly international investors, but actually it's a very attractive market, some very interesting sectors. Maybe we pick this up next time, Ed, but I really appreciate your time today. Thank you very much.
Pleasure. Thank you both for the invite and the opportunity.
Yeah.